And a very good afternoon to you. This is Andrew Horowitz, and welcome to the Horowitz & Company pop-up Q&A webinar for the 14th of September, 2020. We had some time off last week as we were hopefully all enjoying the Labor Day holiday and spent some time trying to get back to whatever the new normal is out there. So hopefully you have that opportunity to decompress a little bit and get outside maybe a little bit, and hopefully maybe a barbecue. Maybe something like that. I was busy working on some crazy barbecue, smoker, brisket, short rib recipes that I was kind of had backed up for a while, and I thought I'd take a go at it. Turned out pretty good. Nothing extraordinary. Got to really get that timing right and the temperature right. If you've ever done any smoking, you know what I'm talking about. Well, here we are. It is mid-September right now. And again, we had a couple of weeks that we really haven't met and spent time. And since then, well, we've had a bit of a mini correction in the markets, particularly related to the NASDAQ, the high tech, the names that were significantly helping and assisting to move the markets higher. And what we saw was during that time, names like the FANGs, right? We saw the Facebooks and the Amazons, and we saw Alphabet or Google and Netflix and Tesla all really see a very significant sell-off. And some of the reason for that is due to a couple of things. I mean, some of the things we've been talking about for a while was, this, I guess, a valuation malfunction that was going on where prices were being paid as if these stocks would move up to, essentially forever. And one of the things we know is that, well, trees don't grow to the sky, right? Nor do prices continually move up. There has to be some foundation involved, and that foundation is the fundamentals, which is based in earnings current and earnings into the future. What is that going to be? And somehow it seemed like everybody was thinking that there was no limitation on how far we could take and stretch those valuations as compared to where earnings were. And that made stocks move up. But really what happened was something very interesting, something we haven't seen a lot of. And there was in the markets a whale. Now, when we look at whales, we often think about the cryptocurrency space because the volume and the accessibility is a little bit thinner, and they have the opportunity to really buy or sell big chunks and take cryptocurrencies along with them up or down. We don't really see it in the stock market as much because there's a higher level of liquidity, and whales are out there in the terms, and we look at those in terms of institutions and hedge funds and maybe even sovereign wealth funds. But what we saw in this circumstance was one particular whale come in, and we didn't know this for a couple of days, but we saw there was the one day that there was an extreme movement with no news, no information, nothing new out there on many of these names, particularly focused in on the NASDAQ names, the technology and biotechs. And again, the names that I mentioned, those FANGs, took a substantial leap higher. We found later was that a company called SoftBank, which is, we know them because they're the ones that funded some of the ride-sharing companies. They go after the small but yet unicorns that are out there, like WeWork, and they pile money in, and they buy big chunks. And then when they do another raise of the raise for further financing of the company, they continue to pile money in. And what happens is, and what they've done in the past is, by the virtue of continually buying in at higher levels, they are forcing the price and valuation of some of these non-traded unicorns, the company's pre-IPOs, through like a venture capital process, to go higher and higher. And they kept doing that. And along the way, there were new players that would come in and bite into that concept. So therefore, they would just continually put money into it, raise the price by themselves, essentially, and then hoping that someone else was going to come in behind and do the same thing. Well, here's what happened. They started buying call options on these stocks, the stocks that I mentioned in the technology area that were really doing pretty well and were some of the major winners from the pandemic, whereas technology was concerned. And what they did was they bought upside calls in the amount of like $4 billion. Now, I want to put this in perspective because $4 billion with options is not like just buying $4 billion, which is a heap of money, into a stock. It's a highly leveraged position. And what happens is that those that are selling those options to SoftBank in this circumstance said, you know what, we need to hedge out those positions. And the way to hedge those out is to buy the stock because they're selling the calls. So if they buy the stock, they have the stock underlying the position, thereby hedging out a portion, if not all, of some of their risk. And therefore, they're willing then to create these options in these amounts and then sell them to the buyer, which in this case was SoftBank. So what happened was two things. Number one, we saw a lot of option buying, and investors that are looking for option buying for tells of what is going to be going on in the future, whereas we're seeing that there are a lot of people willing to pay a substantial amount of money for upside call options. They get triggered and start buying. They also start seeing that the same stocks are moving up because who else is buying? Well, in this circumstance, it was simply the sellers of the options that were creating the options in these amounts, because $4 billion of options is not something that's just readily available. The market is not that thick. It's not that liquid in the options market. So what they did was they saw, one, the first glimmer of information was that all these options were being bought, massive amounts compared to what we saw historically. That was one indication, okay, well, maybe these are going to move up for some reason. The second thing they saw was the confirmation of the stocks moving up because, again, these were being bought by the hedgers that were selling the call options, and therefore it was a double confirmation. Everybody piled in 1 or 2 days, then vaulting these stocks 5, 6, 7% higher out of nowhere. Now, when you talk about Apple moving up 7% in a day or 10% in a day, we're talking about $150 to $200 billion worth of market capitalization move. We see Tesla move up 5, 10, 15, 20% in a day. Massive increases in market cap. So this was a false indication of what was really going on in the markets, and a lot of people got sucked into it. When there was the realization, when it was all untwisted and it was all untwirled, and we found out that there was one major buyer of call options in the market, a light bulb went off and said, wait, these valuations are totally artificial, and we got a correction. The correction, which is a great word, correction. We corrected the price inefficiencies that were going on. And that's exactly what happened in this circumstance where we saw the NASDAQ fall 10% in a matter of a week and a half. And we saw some of these names that were up dramatically fall 10, 15%, correcting down to where the actual valuation probably was more appropriate, even though right now they're still a little bit stretched. And a lot of that has to do with the low interest rate environment that we're having to see now. The TINA that we've talked about, TINA, there is no alternative. So when we combine all this together, what we found was this, we can call it a blow off top. We can call it an acceleration in a parabolic move over the top that, again, was created by a single player out there. So SoftBank, which is now looking to revisit their option strategy because they lost a chunk of money on that, was really the culprit here, which is not something really that is too surprising because this is the way they play. They go out and try to value things above what reasonable valuation is by using a variety of methodologies that are non-standard. And in this circumstance, it hurt a lot of people that got sucked into this kind of situation. So there was this volatility, the Qs, the QQQ, which is the ETF that is represented by the NASDAQ 100, came down and hit his 50-day moving average line pretty much exactly, tapped it, and then bounced. That was the first time it hit its 50-day moving average since April. The S&P 500 came down also, good 6-7%, got close to its 50-day moving average. Again, it hadn't seen that level since April as we saw this incredible move higher post the announcement of all the stimulus that was being pumped in due to the fact that all these lockdowns that were occurring throughout the United States and around the world. And what we have now is a situation where there's a big head scratch going on with regard to, okay, where really are we with valuations? Can we hold these valuations considering all that we know with the recession that was in the past we're coming out of, with still a lot of the country not back to normal. The world, in fact, where we see a backstep where Israel is imposing a 3-week lockdown right now, starting, I think it was Friday. And we're seeing that the openings for some places are happening a lot slower than anticipated. And are we going to be able to get back to a level of overall GDP that's consistent with the levels that we're seeing with the markets? Or is it simply the same thing that we've been discussing, which is that there are a small amount of stocks that are leading it all? So whatever we want to look at with this, and the fact that the Fed, which is going to be announcing their decision this week, we'll get to some of the economics that are coming up in a moment. But right now, there is a big question about how long can we really hold these rates down when we're seeing that there is a bit of a healing process going on with the manufacturing and with retail sales, as well as the employment situation. So there's a concern right now over valuations. We saw the VIX spike up. It's still holding right around 30, which is above average, about double the average of where it is normally, give or take. And probably a lot of that has to do with, here we are 50 days away from the election, which on one side people are saying, well, you know, if President Trump is reelected, that we have more of the same. We have easy monetary policy. We have a fiscal policy that's pretty easy. We have deficits and debt that's going to be monstrosity and gigantic in this horrible situation. But at the same time, it's going to be good for businesses because we have a low tax rate on businesses right now that are going to stay. It's going to be a very market-friendly environment as well. On the other hand, there's some discussion about, and I saw a great piece today on some of the plans by the Biden side where they're going to be raising taxes. And while they'll be taking in about $3.5 trillion in new taxes, they still have about $5 trillion in expenditure. So therefore, we're going to see the continuation of an increase of our debt that we've seen. A budget deficit will lead to even further amounts of debt, the highest it's ever been in the history of the United States. At the same time, you know, you have to wonder, well, how is that going to impact the markets? Whereas we have the potential for a loss of a step-up basis, which is part of the platform that was just recently announced on the Biden side, whereas when someone dies, they get the step-up basis for the people who inherit the asset, and that's a tax-free, essentially tax-free transfer right there from a capital gain standpoint. And then where you have the next level of increase with corporate tax rate, how is that going to impact corporate profitability? Already we're talking about somewhere about a 10% whack to corporate profitability and maybe a hit to GDP in the level of about 1.5%, 1.5 points off of GDP. So there's kind of good and bad on both sides, I guess, in terms of the economic side. One is going to be a little bit more difficult to get through, but better for the long-term stability of our budget and deficit to a degree, small degree. And the other may not change anything. We're going to continue along the path that we have now, which would be much more friendly to the markets. So if you're one that looks to vote with your wallet, you'll have to make that choice of which you think is going to be better, not only on a 2 or a 4-year or an 8-year period moving forward, but really what we have that's going to be, you know, outward. We're really not just, I think, thinking about the next year. We're thinking about the next 4, 8, and 10 years out of what's going to be the better part for the overall, not only the markets, but overall economy of the U.S. So that's something to really just chew on and think about what's going to happen. I don't have an opinion right now because I could see from an economic standpoint both sides of this. And it seems that if I had to project who would be, which party and which president would be more market friendly, I would have to say it's President Trump. There's no question about that. I mean, he looks at his approval and his job, how well he's doing his job by the points and value of the stock market. Really haven't seen that before. I don't think that's going to be the same thing with Biden at all. I think it's going to be a much different situation. So in terms of a market-friendly approach, it's clearly on the Trump side. In terms of the potential for a longer-term program for social and for the deficit and all that, could lean towards Biden. We just don't really know right now, because not only is he raising taxes, which we don't want, but okay, we have to get it from somewhere from all the money we spent. But he's also doing other things that are going to increase spending. So it doesn't really necessarily do much, but it is a market negative from what I can see. Remember something, we really don't know what particular programs either side is going to implement moving forward, right? We all thought, in the beginning, before Trump was elected, Trump's going to come in and he wants to reduce the deficit in a major way. He said, you know what? The Fed should really increase rates moving forward. Rates are way too low, and there's going to be a lot of these other things. And everybody was really freaked out and said, you know what? If he comes in, markets are going to be problematic. Well, as soon as he was elected, 3 hours later, he announced a massive tax cut, which would be the first thing on his agenda, tax cut to corporations. And that's all it was. And the markets took fire from that point. So again, it all depends on what they say to get elected, and what they actually do once elected is a big issue. I'm not going to make this a political discussion, because that's not the point here. I don't really care one way or the other. If you like this side or that side, let's just kind of focus in on the markets and how the reaction would be, because that's what we're talking about, right? Talking about the idea of what is the biggest impact on markets. I'll also mention that what we're doing here today is all about you, and all about trying to keep you educated and understanding of what are the major issues that are really focused, what the markets are focusing on right now, and what is important for us to understand. We also are doing this to answer any questions that you have. The major part of this and the meat of this discussion every Monday is all about helping you with anything that you have on your mind. And what we do is we have this question panel, Q&A panel, that I would ask you, whatever your question may be. I mean, some people have asked me about what temperature I smoke my brisket at. Whatever your question may be, around the area of finance and money and markets, it's important to get in there. I'll mention at this point also, I think it's important to, I should have done this in the beginning, but this is no recommendation. There's no recommendation to buy or sell any security here. It's for educational purposes. None of the information here is designed to give you individually tailored investment advice or accounting or legal. So just keep that in mind, that we did post that disclosure right there. Oh, one other thing I'll mention. If you haven't had the opportunity, some people may have, but we have a brand new virtual tour over on thedisciplinedinvestor.com. It focuses in on the components of the TDI managed growth strategy. It's a really great production. I thought it was, when I got this, I'm like, wow, that's pretty cool. And so you can check that out. It has all the different areas, the area of our quanta and a funda and a techna, and how we pick stocks and why we do what we do in the screening process and what it's all about, and how it's a long short strategy and what it's. So check it out. I put the link in the chat. You can check that out. There's a quick form to fill out just from a compliance standpoint, and that will take you right to the 4.5 minute, 5 minute virtual tour of the strategy to give you some really good insights. And like I said, I think it was done really well, so hopefully you'll enjoy that. So as I was saying, load up your questions, because we're going to get to them in a second. I have a couple more things I want to talk about here. Let me just go down my list of notes. Eco. There wasn't a lot of economics over the last couple of weeks since we met last time. I think that was something that was important to recognize, and in a good way, I guess, that we had just some clear sight for a moment. Not a lot of the noise about some things that were going on. However, we did see the employment numbers, and the employment situation in the U.S. got a bit better. There's some question about seasonality in there. We're still seeing 850,000 initial claims each and every week, and that's important to recognize that people are still signing up for unemployment benefits right now. The stimulus program that is being, I don't know, bantered around, it's kind of like a political football at this point. Seems to me that we can look at this in a lot of different ways. The recent $300 billion package that was proposed was shot down very quickly. That was the Republicans' response to about a $3 trillion program that the Democrats want. Democrats said they came down about $1 trillion. They're in the $2 and change trillion boat right now. The White House is looking at about $1.2 trillion. Whatever the number is, I mean, it's large. Talking about funding further vaccine trial testing, PPE, making sure that do we have enough money at the state level for not only testing, for contact tracing, et cetera. Also looking at replenishing some of the state's budgets, working on the unemployment benefits to $300 per week. It was signed into law via an executive order by President Trump recently. All these things are out there. It seems that there isn't a lot of will to do it right now. And we can kind of speculate a few things. One, if we want to take the high road here, we can say that it's very unclear how much stimulus is really needed at this point. And on one hand, we know that any bill that's going to be put out will be a good amount of fat in there. But how much fat? So at a $3 trillion bill, there's probably a couple of billions here, billions there. That's just excess. You know, if we're talking about a bill that's going to help people through this very difficult time, because this pandemic is still raging on pretty well. Let's be honest, right? If we're going to think about that and we're really focusing in on a bill that really takes care of people to make sure they get through this until sometime in the future, that either this somehow miraculously disappears or we get a vaccine or something else that we don't even have a handle on right now happens, well, we're going to require that people are helped out, businesses are helped out. I mean, I saw a very startling number this week about the restaurant closings in major metropolitan areas around the United States. I mean, we're getting into the winter time, and if indoor dining in New York is only going to be open at the end of this month to 25%, how are they going to have any outdoor dining when it's 30 degrees outside? So we're entering into another really problematic time period for a lot of places around the country. And, you know, we're also seeing that, you know, of course, what's gone on with universities and colleges, and who knows what's going to happen with some of these sporting events that are going to allow for a little bit more people to get in there, and some of these indoor rallies that we saw one last night in Las Vegas. Not a lot of masks with the Trump rally last night. And, you know, when is this ever going to calm down and go away? So we need to have that, but it does seem like if we want to take the high road, there's a good number that needs to be put forth. You know, maybe $1 trillion is the right number if we can cut out a lot of the fat. On the other hand, if we want to take the low road, we could say that, is it possible that there are some people that are willing to drag this along for the next 50 days so that it kind of looks like nothing's being done, and the blame will fall on President Trump, thereby derailing his election hopes? And of course, if the Democrats are going to hold out for a number, allowing people to suffer, again, this is the low road. I'm taking the low road here. Is that possible? I guess all is fair in politics, right? I hope that's not the case. But somewhere in the middle is probably more of a reality, that we need a much larger number than 300 billion, probably not as much as 2 trillion. And again, you know, we could always revisit this. Remember, it takes a long time for stimulus to get into the economy and actually show up. Months and months and months. So we still have a lot of the stimulus probably that we had from the first bill, the CARES Act, the $3.2 trillion that is still making its way through the economy and isn't really showing up very well. So just something there. we're seeing in terms of vaccines, some good news, bad news. We're making progress. Merck came out with an announcement that they feel they'll have something by the end of October. Okay, we'll see how that works. AstraZeneca, last week, one of the leading candidates for the vaccine, put a hold on or a pause on their trial due to the fact that one of the people in the trial that was actively taking the vaccine that was active, not the placebo, came down with some very significant neurological disorder, and they stopped it. And they started again in the UK. It's still paused in the United States till probably mid to late, at least this week or next. So there's remember that it's difficult to get a vaccine for something in the normal course of the process, and now we're shortening that down to a matter, of what, a tenth of the normal time period that we're hoping to get some kind of vaccine. This week's coming up. We have a busy economic calendar. There's a lot happening starting tomorrow, but we also have on Wednesday the big announcement from the FOMC, the Federal Open Market Committee, their rate decision. Now, what are they going to do? What is Jerome Powell going to do? Not going to reduce or raise rates. There's nothing happening. There's probably a nothing burger here in terms of what's going on with the rate. However, in his latest announcement, when he talked about the inflation averaging and why they're utilizing that form of their target and moving away from strict 2% targeting, it's important to note that they are going to continue to pretty much bang that into our heads whenever possible. So at 2:30, when the press conference starts, a virtual press conference, and Jerome Powell is there answering all these questions, I'm sure there's going to be a lot of discussion with regard to the FOMC rate decision related to how this all falls and plays into the inflation averaging, because now we have some time under our belts with the idea of this. Well, what does that really mean? And I'm sure that he will come out and talk about that. They're, again, he's using this little phrase that they're not even thinking about talking about raising rates anytime soon. So we are in this for the long haul. And if you haven't, I'll ask this question. This is something I want you to really think about. If you have a mortgage and you have not refinanced and you are anywhere over or near the 4% mark, I can tell you that I saw last week a 2.25% 15-year mortgage. You could find them right now. And a 1% change in your mortgage can be very substantial for you long term with the interest that is required to be paid on that mortgage. So whether or not you have a mortgage that's new, you got something the last 3 years, or you even have something for the last 8 years, I would bet that probably this rate is lower, 2.25%. The process, well, you probably have a lot of the stuff handy. You just upload it. It's very easy these days to get through the approval process and all that. And make sure, a couple of things for any clients that are listening, if you go through this process, we're here to help you. Look at what the terms of the deal are to make sure there's no embedded costs that are absurd. How to save you some money. So we've done this quite a bit. If you want any insights from us, once you find a deal that you're looking for, if you're looking for it or just want to talk about it, just give us a call. Our phone number is on the screen right there. Our email is on the screen right there. You know how to get in touch with us. But I would really highly recommend and suggest that you go out and look for the opportunity to refinance your mortgage at these incredibly low rates. Okay, let's see if I'm done with my notes. Oh, we have consumer confidence coming out this week also, and some more housing numbers. Housing's been hot. Housing's been hot. It's been very good with these low interest rate environment and the massive move from the city centers. This deurbanization trend is real. It's happening. It was just an idea that I had when I looked at some of the things that were going on with the post-virus stress disorder, PTSD, that could be coming, and a lot of people don't want to live in multifamily homes, particularly in city centers, in the metropolis. They want out, and they want to find a place where they can have a little bit of lawn, or at least get outside of the thought of having to go up 40 stories or 20 stories in an elevator just to get out. God forbid this ever happens again, or if it continues for some time to come. All right, we're going to get to the questions here. Like I said, please, any questions you have, there's no question that is too small, insignificant, or that you'd be laughed at. There's nobody here that will laugh at you. Well, I could, but I'm not going to. So please do me a favor, ask your questions. That's what this time is dedicated for. That's what we're doing each and every week. And finally, I'll mention that we put these up. They're available over on the YouTube channel. You can go over to thedisciplinedinvestor.com as well to get the replays if you've only able to listen to a couple of them or you miss a week here and there. And finally got a Facebook page that is respectable. I think it was my son. He said, "Dad, your business doesn't have a Facebook page." I said, "I know we do a lot on Twitter. We really don't do a lot on Facebook. It's got to have a Facebook page." I said, "Okay, make me a Facebook page." So you can find out because we post these kinds of things up there as well. And you can follow The Disciplined Investor on Facebook, our podcast, all that's up on that site. So go like that and follow it. All right, let me get this. All right, first question comes from Alex. And Alex asks, hey, Andrew, I am currently a bit tech heavy in my allocation, mostly non-FANG. It's doing fine, and I don't think I want to sell much, if any, now. However, I do not have more to invest, and I'm thinking of doing more defensive and cyclical stocks moving forward to rebalance instead of selling out of the tech. Thoughts? Well, a couple things you could do, a lot of different things you could do, but that's not a bad idea. There's no question that obviously having diversification, particularly in a time when it's so weighted in one direction like we are seeing right now, I mean, we don't usually see this last at this kind of level for this length of time. So yes, I think it would be good. And probably if you don't want to have to pick individual stocks, maybe you want to think about looking at ETFs, the consumer staples possibly is something, or maybe one that is heavy. You mentioned defensive. I think you're thinking the broad picture, but defense is also in that genre too. The only problem you're going to have is you need to think ahead 50 days. If Trump wins, well, defense will probably do very well, the defense stocks. If Trump doesn't win, well, maybe not so much. So I think the cyclical stocks are probably a really good idea at this point. Banks have just been obliterated. They're probably going to be that way for a while unless there is some kind of change to the Fed's policy, and I just don't see that happening right now. But I think, and more importantly, you should look at some of the inflation-oriented diversifiers, whether it's things like tips, or you look at, like you said, the cyclicals. That could be something that's very smart to do. I don't think you need to probably consider dumping things that are working for you, but just be on the lookout. And then once you get rotated, depending on your age, depending on your time horizon, depending on your risk tolerance, you may want to do what exactly you're talking about. So I think that's a really good idea to consider that. This next question comes from Michael. Are you using something other than bonds to help balance your portfolio's equity positions in case of a downside move? So a few things. Yeah, that's a great question, because what is really out there, right? That's the big question. What's out there that you could use as some kind of a maybe non-correlated position in your portfolio? And we constantly are looking for those opportunities. So there are different kinds of bonds that we use. So that's first of all. We don't just use bonds. It's not just bonds. It's certain kinds of bonds. Like, for example, we prefer to use short duration and short maturities. So low duration, short maturity bonds right now, as the interest rates are at an all-time low. Which, are they going to move down more? Well, if they move down, we'll make some money on that. Not as much maybe as if we had longer bonds or midterm bonds, but nonetheless, I feel comfortable with that. Number one. Number two, you want to look for things outside the range of what is really being controlled by the Fed. Now, there's other central banks around the world, of course, and what you could do is you could look for international, non-U.S., foreign, emerging bonds that also are something. So that's your bond discussion, right? You got tips, short durations, outside the U.S., emerging/foreign. Now, let's get well outside of that. Let's talk about potentially real estate. So real estate is possibly something that can do well, very interest rate sensitive as well, but is a little bit less correlated to equities, let's say, than, well, equities, okay? Then you have things like commodities. Now, commodities have not really done well. It's very difficult to find a good performing commodity fund right now for the last, I don't know, few years. They're starting to pick up pretty well recently, but those should not necessarily have as much correlation when you have things like the ags and you have the agriculturals, foods, if you will, as well as the oils and fuels. And you have on top of that, you have the metals, a variety of metals. So that's another piece. Now, another one on top of that is alternative asset classes, and there's several different ones we use for clients, or that we have at least on the block that we can use. A couple, really one we focus in on, but you can look at things like fund to funds that do things outside the correlation coefficient, or really outside the market moves. So what we're trying to avoid here, Mike, is the whole idea of, well, if I have a portfolio and things fall apart, I don't want everything falling apart. And if you remember, I talk about something called our flower garden theory. That with a flower garden, if you're up north or if you're down south, depending on the time of year it is, you can plant some beautiful flowers that look great in the summertime, but in the winter they all die off. Well, you don't want your portfolio looking like that. In the wintertime, what do we want? Well, we want things that will work, at least have a stable presence, like an evergreen. Think of that, right? Or think about certain ivies and greens. Think about, roses will pop up at certain times of the year, heliconias other times of the year, and impatiens other times. So you want to have something that's working at all, potentially working at all different times. You want your portfolio looking like that as well. Now, I'm getting around this very long-winded answer to a very simple question, because we can have things like credit arbitrage, we can have event-driven, and we can have option alt strategies that are not as correlated to the markets. And when you have those and you diversify it, I would say, quote-unquote, correctly, you have a portfolio that can withstand some of the downside pressures. The other thing we have is cash right now. We have an excess amount of cash that we came into the year with, and we're not really bumping it up too much because we're just doing just fine. Clients are happy. Could we have made more? Yes. Could we have lost more? Possibly. So what's happening right now, until we can get beyond this moment in time, we are sticking with our non-correlated assets, commodities, real estate, and our bond diversification, as well as our equity orientation that is fully diversified domestically, internationally, small, large cap, mid, and all of that. So the only problem you have is that there is the problem that in the last go-round, there was so much selling that it took everything down with it. That's the one thing you need to be careful of, and make sure you diversify in a way that, again, has enough correlated positions that it all doesn't get whacked at once. Good question. Next question. How to protect, it says protest, but I don't think that's right. How to protect our IRAs from inflation. I think that's a really interesting thing, that inflation right now is picking up substantially. And it's not really being shown in some of the official numbers. But if you dig down and you look deeper and you see what people are actually spending on things, whether it's your car insurance, even though they gave you a 15% discount, some of them, they raised your rates. Moving forward, food costs are up. Lumber costs are through the roof. Commodity costs are through the roof. Everything seems to be going up. One of the things you do is, obviously, you have, I don't want to sound like a broken record, but you have some equity exposure to that. It usually will help as an inflation hedge. But then look at things like TIPS and some of these other alternatives that can give you a hedge for inflation. That goes for IRAs, and that goes for non-IRAs too. But if you're looking at things like having CDs in your IRAs, there's really not an opportunity to protect it from inflation right now with the Fed as active as they are. Next question comes in. Hey, Andrew, can you see or hear everyone in Zoom? No, I can't hear anybody. No, and I can't see them. No. It's just, this is just an audio with a screen share. So I'm not looking at, oh, nope. No, I'm kidding. I can't see you. Anyway, I see some SPACs. These are special purpose acquisition companies offering warrants. I can only see the 5-day history on Yahoo Finance. Please advise how you look at the historical price in longer term. I think probably that you need a platform like a TD Ameritrade platform, a Schwab, a Trade Station, Thinkorswim, something like that, Interactive Brokers. They'll probably give you a longer term on the warrants. I'm not sure why you're going after the warrants. They are much more aggressive, and they trade a little bit more in a crazy manner than the underlying. There's plenty of opportunity in the SPACs themselves, and this is kind of a moment in time that I think we're going to remember, because I don't think it's going to last forever, these SPACs, but nonetheless, I think that you have to get a probably a paid service to do so. Our last question comes in from Ken. And if you have any questions, get them in real quick before I finish this, because otherwise we're going to sign off. So Ken asks, with interest rates near zero, why do you think that the high dividend value stocks have not moved up as much? I think the value stocks right now are stuck in a lot of those. If you look at them, they're related to banks and banking instruments. And I mean, we saw what happened with Citigroup today, went down about 5%. There was they got slapped on the wrist for some risk management issues. So I'm not exactly sure which ones you're looking at, but everybody's really leaning towards growth. In a time when it's very difficult to get any kind of growth of earnings, growth of revenue, where you have names that can do so, they're doing really well. Dividends are really important. They probably moved up from the lows and over time if you track them as compared to interest rates, but the core companies themselves may be having a little bit more of a problem in this environment with interest rates as low as they are. We're not in a normal interest rate environment. We're in an emergency interest rate environment with a very flat yield curve, and that does not do well for the companies that maybe you're thinking about, particularly the banks. However, I don't think that's going to last forever. These are cash cows that make money in every market condition, and they're pretty healthy right now, their balance sheets. So I don't know if it's necessarily something to walk away from. On the other hand, have they really gone down either? I mean, if they've came up and you're getting a nice dividend, you're getting an extra piece from them as well. So it's pretty much due to the interest rate environment that we're in and the overactive Fed that we're seeing as well. So and due to the fact that their growth may be a little bit stymied due to the fact of the high unemployment that we have right now. So that does it. That looks like it does it. So let's close this. I'll see you on Tuesday, hopefully, for DH Unplugged, live at 9 p.m., dhunplugged.com. And, of course, this week we have coming up Linda Ratchke, who is a well-renowned chart trader, and she'll be on the Disciplined Investor podcast this week. Last week we talked about the whole idea of moral hazards on the Disciplined Investor podcast. Make sure you check that out. Thanks a lot for being with me, and I will see you again next Monday.